In mid-2024, United States gross national debt crossed $38 trillion. The federal government accumulated the latest trillion in just 71 days. A velocity of debt accumulation of this magnitude is historically isolated to periods of global pandemic or total mobilization for war. Yet this current acceleration is occurring during peacetime economic expansion. The mathematical reality of this trajectory prompted a formal reevaluation of U.S. solvency. Moody's executed a historic decision, downgrading the United States sovereign credit rating to AA1. The rating agency cited a specific rationale: the combination of mounting interest costs and persistent, unmanageable federal deficits. Domestic political debates treat this as an internal dispute over taxes and inflation. However, the mathematics of U.S. debt issuance represent a systemic vulnerability for the entire global economy. U.S. Treasury bonds function as the undisputed bedrock collateral of the global financial system. When the foundation of the world's reserve asset begins to erode under the weight of oversupply, the consequences are not contained within American borders. The vulnerability scales internationally. By tracing the mechanical relationship between U.S. fiscal imbalances and global credit markets, we can map exactly how the United States exports financial crises to the rest of the world. This chart shows the structural relationship governing national solvency. The green line represents real economic growth, or G. The blue line tracks the real interest rate on sovereign debt, or R. For decades prior to 2021, the United States operated under a mathematical regime where the interest rate remained lower than the growth rate. This gap provided a fiscal buffer. It allowed the government to issue continuous debt without a proportional requirement to raise taxes. The economy simply outgrew the borrowing costs. Post-pandemic inflation and the Federal Reserve's restrictive monetary policy broke this equilibrium. The real interest rate spiked above the economic growth rate. The cost of carrying debt now outpaces the economic output required to sustain it. The Congressional Budget Office projects that 10-year Treasury yields will average 4.4% through 2036, cementing this inversion. Under this restrictive rate environment, total publicly held debt is projected to reach 120% of U.S. GDP within the same timeframe. Net interest outlays alone will surpass $1 trillion annually. To provide scale, that $1 trillion interest burden exceeds the entire United States national defense budget. This specific expense is inescapable and compounding automatically. When a government borrows money simply to pay the interest on previous borrowing, the velocity of debt accelerates geometrically. Debt service now functions as a self-reinforcing driver of the primary deficit. In macroeconomic terms, sovereign debt pricing relies on a concept known as the convenience yield. This yield represents the pricing premium that investors willingly sacrifice. They accept lower financial returns in exchange for holding the ultimate liquid safe haven asset. The current supply of new treasuries entering the market challenges this historical pricing model. This scatterplot visualizes data from the National Bureau of Economic Research. It plots the U.S. debt to GDP ratio on the x-axis against convenience yield premiums on the y-axis. The empirical finding is absolute. Every 1% increase in the U.S. debt to GDP ratio strictly correlates with a measurable drop in the convenience yield. Specifically, each 1% increase drives a drop of 0.37 to 0.86 basis points in the premium. The sheer volume of debt issuance is actively outpacing the intermediation capacity of global banks to absorb it. This data confirms that the safety premium historically attached to U.S. Treasuries is actively eroding. We can observe this clearly by comparing the U.S. trajectory against sovereign peers with lower debt burdens. Nations like Australia and Germany retain their pricing premium precisely because they strictly constrain their debt supply. The sheer volume of U.S. debt issuance has broken its historical pricing privilege. The true cost of this shifting yield curve falls heavily on emerging market and developing economies, or EMDEs. Developing nations rely on precise borrowing conditions to maintain sovereign stability. The World Bank draws a critical distinction between two types of U.S. interest rate shocks and their impact abroad. The first is a real shock, driven by genuine U.S. economic growth. This scenario is relatively benign, as a thriving U.S. economy stimulates global trade. The alternative is a reaction shock. This occurs when the Federal Reserve artificially hikes rates strictly to battle domestic inflation, which creates toxic spillovers. This map shows the mechanics of a reaction shock. A rising U.S. Treasury yield curve acts as a financial vacuum across the global network. Higher guaranteed returns in the United States trigger severe capital flight. Institutional investments rapidly exit developing nations to chase American yields. The immediate result is plummeting domestic currency values across these emerging markets. To survive the outflow and maintain dollar-denominated debt payments, these governments are forced to slash critical local spending. The World Bank tracks this effect using a highly nonlinear crisis multiplier model. A mere 25 basis point increase in two-year U.S. yields nearly doubles the probability of an EMDE financial crisis, jumping from 3.5 to 6.6%. Through these exact mechanisms, U.S. domestic inflation fights mechanically engineer foreign sovereign defaults. Beyond long-term sovereign yields, this debt load also disrupts the immediate short-term plumbing of global finance. The U.S. Treasury operates the Treasury General Account, or TGA, to manage daily federal obligations. During political debt ceiling standoffs, the Treasury is forced to drain the TGA. This temporarily injects massive liquidity into the financial system, only to rapidly reverse course once the ceiling is lifted. This chart recreates IMF data tracking those liquidity swings. When the debt ceiling is lifted and the TGA rapidly refills, it withdraws reserves so fast that short-term borrowing costs, like the GC repo spread, aggressively spike. U.S. political brinkmanship creates severe global dollar funding crises, completely independent of actual sovereign default risk. The U.S. dollar undeniably remains the dominant global reserve currency, but the exorbitant privilege attached to its debt is visibly fracturing. A debt burden expanding past 120